Folks, the day we've been waiting for is finally here. PayPal just reported their Q4 results and the conference call just ended. I finished listening to it and the stock is down nearly 8%. And I'm left sitting here scratching my head at how a stock can be down nearly 8% on absolutely stellar Q4 results. We'll jump into the revenues, the earnings. We'll take a look at why Wall Street is continuing to sell this stock off, in my opinion, for the wrong reasons. We'll take a look at their guidance, the headlines that are still making news over at PayPal, namely their active accounts. We'll jump into all the financials, and then we'll come in here, take a look at it from a stock chart perspective. This one really has been in an ugly downtrend, and I think can continue to head lower. But in my opinion, PayPal still represents one of the best risk rewards that is still out there in the market. It's probably a buying opportunity like we haven't seen maybe ever in the stock market. We'll jump into that and a whole lot more in today's video. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Shares of PayPal down nearly 7.5%, down to $58.50. That's despite the stock being down nearly 24% over the past 1 year and now trading at a market cap, we'll call it south of $68 billion, likely close to $60 billion come tomorrow morning. Now, PayPal's revenues for this Q4 coming in at $8 billion. That was good for 8.1% growth year over year. That did beat expectations on Wall Street by roughly $130 million. So came in with a top line beat. It also came in with a bottom line beat as Q4 non-GAAP EPS came in at $1.48. Wall Street was expecting $1.36. So while Wall Street was expecting 9.9% growth on that bottom line, PayPal came in with 19% growth on that bottom line. So we got a double beat both on the top and bottom line. On top of that, you have Q4 total payment volume, otherwise known as TPV, that increased 15% and 13% on a foreign exchange neutral basis, up to $409 billion. Full year 2023 total payment volume increased 13% and then 12% again on that foreign exchange neutral basis, up to $1.5 trillion. That's for the full year 2023. So both top line increasing, bottom line increasing, and then total payment volume increasing. Those are good signs over at PayPal. On the surface, looks great. Now, why is the stock selling off? Still nearly 8% in the after hours. That is likely due to guidance. So first of all, Q1 2024 guidance, non-GAAP EPS coming in the range of mid-single digit growth. And that is really what Wall Street was expecting. We look ahead to Q1 of this year, $1.26 on that EPS figure. That is right around 8% growth that Wall Street was expecting. PayPal guiding basically in line with that at mid-single digit growth. And then on that revenue side, approximately 6.5 to 7% growth on those Q1 revenues. Again, Wall Street basically in line with that at 7% growth. Now, as we look ahead to their full year 2024 guidance, that is really where it differs from Wall Street. So non-GAAP EPS for the full year coming in the range of in line to their prior year. So they just posted a full year EPS figure of $5.10. And now PayPal is saying that is exactly what they're expecting for the full year of 2024 as well. Now, Wall Street was expecting a figure closer to $5.53. So that is a miss of roughly 43 cents on that full year EPS. And so when Wall Street expects 11% growth for this upcoming year, and then PayPal says, yeah, they're basically not going to grow their bottom line and come basically where they were in this past year, that is going to be disappointing over at Wall Street. Now, there are a few reasons why PayPal guided in line to their prior year. The first reason is because they will take a few restructuring charges over in 2024. So PayPal announced a round of layoffs. This came out roughly around a week ago, that throughout 2024, they're going to continue to cut costs and drive more efficiencies. And those include layoffs, frankly. And so that will impact PayPal's full year 2024 non-GAAP EPS. It will likely cause some restructuring charges throughout the year that will hurt in the short term, but will ultimately help PayPal be positioned for long-term success. And then the other thing is that this non-GAAP EPS number of coming in line at $5.10 does not include any benefit from their innovations that they announced back at the end of January on their innovation day. So PayPal is basically saying, yeah, if you throw those innovations out the window, if they basically do absolutely nothing over at PayPal, then we'll still come in with $5.10 for the full year EPS. And I want you to just think $5.10 for a company now priced at $58 in the after hours. Is $5.10 that bad of a number? If PayPal does come in with what they're saying at $5.10, and first of all, this number is a bit sandbagged considering what Alex Chris said on the conference call, that they're looking to first put points on the board before they really come out and set expectations too high for those EPS numbers. Even if they come in with just right at $5.10, is that really bad for a company, again, priced at $58? That puts them right around just over 10 times this year's numbers in 2024. That is not a company that's priced for revenue growth of roughly 8% for the full year, which is also what they're saying. But at just 10.5 times a forward price to earnings multiple, PayPal is really just priced for failure. This company is getting no respect from Wall Street. Those innovations that PayPal announced back on their innovation day basically means nothing to Wall Street. And if this company just continues to execute like they have, they'll generate that $5.10. And on Wall Street, that is the sign of a dying company, apparently, considering the fact that they are pricing in at a price to earnings multiple right around 10 times based on this move in the after hours. So that is, in my opinion, the first red flag why PayPal is falling, is because they came in with that non-GAAP EPS slightly lower than Wall Street expectations. But again, that includes those restructuring charges, and then it also doesn't include any benefit from those innovations. I think this guidance really isn't that bad of a number, considering what this company is valued at, and really that those innovations aren't being given enough credit. Now, for the full year 2024, they also guided for free cash flow to come in approximately $5 billion. And then they will look to return almost dollar for dollar and more to the shareholder in the form of share repurchases, saying at least $5 billion of a share buyback in the fiscal year 2024. Keep in mind, this company tomorrow likely valued somewhere around $60 billion. And so $5 billion of a share repurchase is a significant amount. In this most recent year, PayPal bought back roughly 4% of their outstanding shares. And so this company continuing to execute on that share buyback, which in my opinion, at a price of right around $60 is a pretty good idea, again, considering the valuation that we just looked at. So the guidance was the first reason why I think the stock is selling off. The other reason is due to headlines just like this one. PayPal Q4 earnings beat, like we looked at, fantastic earnings, but active account slip. For some reason, Wall Street is still stuck on this stock in the form of active accounts. For some reason, they still want to see active accounts growing for absolutely no reason. This company has it stalled out on active accounts growth. Yes, absolutely. You look back at Q4 of 2021, this company had 426 million active accounts. In this most recent quarter, they're sitting on right around 426 million. So basically for 2 years, they have not grown their active accounts. It sort of rose a little bit and then has declined over the past, you can call it 4 to 5 quarters. So have active accounts stalled? Yes, absolutely. But the other thing that I think is more important that Wall Street really is missing is the transactions per active account, otherwise known as TPA. We look back to Q1 of 2021, they were at TPA growth of 7%, and over the quarters, as that's gone along, that number has now accelerated up to 14% growth on that transactions per active account. So while PayPal has less active accounts, they're driving more transactions through those active accounts, and ultimately that helps PayPal's total payment volume, or TPV, and it filters out those accounts that were sort of just sitting there but no one was using them. There was no money flowing through it, and basically those active accounts weren't really active at all. And so this, in my opinion, is a good thing over at PayPal. The fact that these active accounts are churning through inactive accounts and that transactions per the existing active accounts are growing. That means the people that actually use PayPal are not just using it, but using it more and more. And again, that is, in my opinion, a better sign than just growing active accounts aimlessly and not really focusing on your transactions per active account. I think Wall Street really has to sort of flip this story on its head and take a look at it from a different lens. It doesn't make sense to grow active accounts. And the fact that this is still continuing to make headlines, despite numerous times PayPal saying that they're looking to churn through those low activity users, still just absolutely baffles me. The fact that transactions per active account aren't given enough credit. I just don't seem to understand that over at Wall Street. Now, like we talked about, PayPal's to start a round of layoffs that is as part of their cost-cutting drive that CEO Alex Chris is so focused on. And this was from his opening remarks on this press release. They are looking to drive profitable growth. This is the keywords over at PayPal: drive profitable growth in the years ahead. That is really what PayPal hasn't done. When you see active accounts have been growing in the past, but the transactions through those active accounts not really growing as meaningfully, that just means PayPal had been growing in the past, but not really growing in a profitable manner. And that is what Alex Chris is looking to flip on its head. They've also added key talent to their leadership team. So the whole C-suite coming in at PayPal is looking to accelerate innovation, velocity, and impact as we saw from their innovation day back at the end of January. And then they're taking actions to realize cost savings like this layoff that they just announced, roughly 9% at the end of January, and then they're going to reinvest in their most important initiatives. So they're looking to divest out of businesses that really aren't generating revenue growth over at PayPal and are focused on reinvesting that where it matters over at PayPal. Now, 2024 is a year focused on execution to position PayPal for long-term success. So we remember Mark Zuckerberg labeled the year of efficiency over at Meta in 2023. Looks like PayPal's 2024 is the year of execution. And I think if PayPal really can just execute properly and just manage costs, continue to provide value for their merchants and customers, this company is really going to be in a strong position beyond 2024. Looking ahead to 2025, I think 2024 will be a year where this company looks to turn around. They look to focus their business in the right direction, and that certainly doesn't happen overnight for a company so large with so many users worldwide. And so I think PayPal is on the right tracks. They're making the right strides. It just needs some time to play out. And I think Wall Street really isn't giving this one enough time for that to happen. Alex Chriss has only been CEO for 4 months. And in 4 months, he's done quite a bit. He's said quite a bit. He's had an innovation day, and he's looking to drive this company towards success. I think Wall Street will come around to this. They're just not giving it enough time right now. Now, they also announced in this most recent Q4 an enhanced accountability and transparency. This is also something, as an investor, I absolutely love. PayPal will begin including stock-based compensation in part of their non-GAAP results beginning in Q1. So generally, GAAP results or generally accepted accounting principles already include stock-based compensation, and that's why GAAP results are generally harder to manipulate, as a company with a large amount of stock-based compensation can have really good non-GAAP results, but their GAAP results won't look all too good. Now, what PayPal is going to look to do is include those stock-based compensation numbers as part of their non-GAAP results. It'll make the company more focused on making sure they're continuing to spend their money most effectively. They don't want to be handing out a ton of stock-based compensation when they really don't need to. Yesterday, we took a look at Enphase Energy, and if you go through that report, yeah, you'll just see how much stock-based compensation, at least compared to their net income, they hand out. And clearly, when PayPal does that, it is not seen as something that's respectable. The other thing they introduced was new supplemental metrics. As we saw, this slide was actually something PayPal started introducing in this most recent quarter, and what they included was monthly active accounts. They previously did not used to disclose their monthly active accounts. You see over the past, continuing with active accounts, that has also begun to sort of flatline and not really grow. But like we talked about, TPA, I think, is the number that matters most over at PayPal. Moving on to their Q4 financial results, we took a look at the qualitative piece for PayPal. Really, when management says that this is a year of execution and innovation, that is the qualitative piece for PayPal's long-term success. But when the bears say that this company has stopped growing, that PayPal is a product that no one uses, I want you to take a look at their Q4 numbers, which shows otherwise, as TPV grew at 15% north of $400 billion. We take a look at non-GAAP results. Net revenue is coming in at $8 billion. Last year, you were at $7.3 billion. That is growth of 9% on that top line. And then everything else grew faster than your top line. Operating income growing at 11%. Your operating margins expanding 39 basis points, now up to 23.3%. When people say unbranded checkout is taking over at PayPal and their operating margins are going to drop, yeah, come in here and take a look at their Q4 non-GAAP operating margins rising 39 basis points year over year. That is also one of their goals over at PayPal. They want to accelerate their branded checkout. Again, that helps margins. And when people say that unbranded checkout is really taking over at PayPal, just show them the operating margins rising roughly 39 basis points. On top of that, you have net income climbing 13% up to $1.6 billion. Last year, you were at $1.4 billion. Free cash flow climbing 72% up to nearly $2.5 billion. That is just for the most recent quarter. For the full year, paints a similar story. You have 8% growth year over year, expanding operating margins roughly 1.1% on the full year, and then EPS on a diluted basis growing 24% as well. So both this most recent Q4 and the full year of 2023 posting strong results. I think that is expected to continue over at PayPal. They'll continue to see top line growth of roughly that mid-single digit percent. And then with that $5.10 in bottom line EPS, they're guiding their bottom line won't see this 24%. In fact, it'll see 0% growth year over year if they come in line with their expectations. But Again, keep in mind, I think that number is sandbagged. And if PayPal really comes in with the execution on their innovations, I think PayPal has a large potential to surprise to the upside on that bottom line number. Now, in terms of cash flows, we saw $1.4 billion of net income. That is substantially higher than same time last year, where we were closer to $920 million. We get to add back not a ton of stock-based compensation. Again, just $388 million on net income of $1.4 billion. This company is still not handing out a ton of stock-based compensation. You look at a peer like Enphase, and yeah, that stock-based compensation compared to their net income is just absurd. And the fact that PayPal is looking to now include stock-based compensation as part of their non-GAAP EPS numbers, in my opinion, that's just another fantastic thing that they can do just for more transparency for the investors. Now, net cash provided by operating activities coming in at $2.6 billion. That's for just the last 3 months. We'd look back over the last full year, it came in at $4.8 billion. And then cash flows from investing activities, not a ton used in investing activities. This company is pretty low on CapEx, and so they use right around $500 million on investing activities, and then used roughly $600 million in the purchase of their common stock. So the buyback is really the main way that this company is looking to return cash to you as the shareholder. And in my opinion, buying back the stock at such a low valuation makes a lot of sense. This buyback was in place last year. It looks like it has slowed down just a little bit, but for the full year, repurchased nearly $5 billion worth of common stock in 2023. They did roughly $4.2 billion in 2022, and the fact that they said they'll do at least $5 billion in 2024 is also another great sign. This company is really reducing its share count, returning more EPS to you as the shareholder, and then they still have quite a bit to add on to their cash pile. From a balance sheet, this company is looking phenomenal. They're sitting on roughly $9 billion of cash and cash equivalents, another, call it $5 billion in short-term investments. And so current assets coming in at $62.5 billion, not a whole lot of liabilities, just at $48.5 billion of current liabilities. And then long-term debt coming in at $9.6 billion. So from a balance sheet, this company looking fairly strong, fairly healthy. Not the best balance sheet on Wall Street, certainly, but the fact that they're still looking to print a substantial amount of free cash flow, nothing to worry about, and the fact that they have more cash and cash equivalents than debt is another good sign. So all things considered, this most recent Q4, phenomenal over at PayPal. This most recent 2023, also phenomenal. And then their Q1 guidance coming basically in line. It's just their full year EPS guiding coming in shy of Wall Street expectations. Now, in terms of the stock price, this one is heading lower, roughly 7.5%, now down to $58.50. I've put in this fake red candle. It was basically at the top of this downtrending channel. So from a technical perspective, getting rejected here does make sense. Looks like PayPal is wanting to head lower, maybe not all the way down to the bottom end of this channel this time, but the fact that Wall Street is continuing to sell this stock off, really from a technical perspective, this one still looks ugly. And if there's one reason I think you shouldn't buy PayPal, it's just based off this chart. If you look at the fundamentals, if you look at the financials, if you look at the qualitative piece over at PayPal, and if you really believe that the innovations that management team is setting out will be executed, then this company is a no-brainer of a buy. But when you take a look at the stock chart, the fact that this one is making a series of lower highs and lower lows, and it continues to head lower, doesn't matter what numbers they post, and doesn't matter what they say they will do, the fact that Wall Street still not pleased with PayPal just shows that this stock is really fallen out of favor, and at this price point is basically priced for failure. And so if PayPal can continue to execute, if they show that 2024 is a turnaround year, and they can continue to have users use their platform along with Venmo, keep in mind this company still owns Venmo, that is absolutely not priced into the stock. And so from a valuation perspective, I think this still represents one of the best risk rewards out there in the market, probably the best risk reward out there, considering that they're trading at just a 10.5 times this year's earnings. Yeah, this company is really priced for failure. If this company does come in and just meet expectations, at some point they will be rewarded. And if they come in and beat expectations, yeah, you're probably looking at somewhere between a 2x and 3x return on shares of PayPal. That was my take on PayPal Holdings, a company I'm still bullish on. I still love for the long term. In fact, this dip is probably a fantastic buying opportunities, considering that their Q4 results came in fantastic and that Alex Chris on the conference call really said all the right things. PayPal is looking to continue to execute in the correct way, and they're setting themselves up for long-term success. And that's really good to see in a stock that I'm looking to hold for the long term. Let me know your thoughts on this one in the comment section below. A very polarizing stock. Needless to say, whether you love PayPal or absolutely hate it, let me know in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.